We started the day with some slightly less than stellar and less than expected jobs data. Don't fret too much about that though. We still got 500,000 jobs added in the month of May. That's pretty good. But don't hop in the other camp either, where Joe Biden clearly is, saying that this is a miracle. He's done so much for jobs. Yes, he's added a lot of jobs under his presidency, in which he inherited a vaccine and followed the already in place plans to implement that vaccine. So I'm taking a little bit of the middle camp, which is, we're adding jobs. We're not adding a whole lot of jobs. It's not anything special. And there's certainly still a lot of people on the sidelines who aren't taking jobs and they're getting unemployment benefits. And if you ask me, it's no question that those unemployment benefits are leaving some people at home, particularly people that, can kind of go with or without a job. I know a lot of people who are collecting those benefits and choosing to collect the benefits rather than get a job. So that's another person on the labor force. And that means that the cost of labor is going to go up, as we saw yesterday. It did go up slightly. And we expect it to continue to be the case as the labor pool and the available labor pool shrinks. Yet there are, so many jobs open. I believe 8 million as of the last count. Yet we can only close the gap by 500,000 in the month of May. It's a little strange if you ask me. Those are jobs just open. They are craving people to come on in, and they're not getting filled. It's a problem. It means that prices might go up, as they already are. And, in a typical environment, we might view an unemployment situation less than expected as not a good thing for the stock market. But in the current stock market, the trend of last summer still remains, and that's that bad news is good news for the stock market. Why is that? The Fed, the federal government, everybody has to stay accommodative to the current environment of employment and the economy. And if it's not recovering as quickly as they expect, it means stimulative for longer by those guys. So we saw bond yields tick down. Now, this is short-term thinking, in my opinion. This idea that inflation is less likely to occur now, given this situation. That is true. Inflation is less likely to occur in the near term because less people working, less demand, maybe all of a sudden, demand seems pretty strong still. But it means more stimulus, more printing of money, and tapering is farther away. So in the long term, I think this does mean more inflation. And these concerns are what has led Russia to divest their US dollar assets. Now, I'm not necessarily sure they're so concerned about inflation because the entire world is engaging in the stimulus, right? It's not necessarily, the US is printing all this money. Like the US they are printing money and maybe not even the most money. They're printing a lot of money, but certainly receiving the most benefits. The United States is the fastest recovering economy. There's a good chance we are going to build back better, come out of this stronger in some way. And it also looks like in a more unequal way. We'll see what happens with that. But the rest of the world is doing that as well. Russia and China, though, want to do something called debase the dollar. The United States has been the base currency, the reserve currency of the entire world for some time. That works in the United States' favor, not in the favor of adversaries like Russia and China who are engaging in cyber warfare, it seems, and possibly even biological warfare. We're not going to go into that in this video, but just something to think about and try and connect the dots with. But they don't want the United States having the reserve currency. They'd much rather it be Bitcoin. It's just so the United States doesn't have that kind of leverage or doesn't have that kind of power. Obviously, they want it to be the yuan, the digital yuan, or the ruble. That probably will never happen, but they just want not the dollar. So I view that as purely a headline thing, not really fundamental. It didn't move the market. It didn't provide a lot of liquidity into the market. Unlike when the Russians sold all their gold once they got the vaccine. That moved the gold market. That's a very easy market to move. So these are just thoughts for the day. As for where the market goes from here, growth stocks might get a little bit of a run just because of interest rates. But I don't want to be trading on interest rates, right? I want to be assuming the long-term picture with interest rates, which is that they're going to go up. So I don't want to buy a basket of growth stocks because I think, oh, interest rates are coming down. That means growth stocks go up. I'm tired of this machine thinking. I want to find good prices, buy the stocks that are priced well, pay a dividend, whatever it is, for fundamental reasons. And there are still growth stocks you can own in a rising rate environment, but they have to be growing dramatically. So the way I've been describing this is envision the future and envision the technologies you think are going to be a super important part of that future, and you want to invest in regardless of the economic climate. Then take a look at the price. Does the price have the potential to 5 or 10x? Interest rates won't go to 500 or 1,000%. If that happens, we'll be on Bitcoin. Then you won't need to worry about it. Possibly, that presents deflationary thoughts, but we're far from that reality yet. So if that's the case, if it's got that 5 to 10x potential, buy it. That's the growth stock you want, and maybe you'll get a short-term boost because interest rates fall. Regardless, energy is still well priced, still cheap. Stocks are very cheap. They pay good dividends. If you don't have exposure to energy, you're going to want it because if there's inflation, they can adjust. If interest rates rise, they'll do well. So energy stocks, well priced now, well priced for the future, and hated. We like stuff that's hated, but still good. So with that concludes today's video. And until next time, peace out.